What's going on, everybody? Welcome to Pineda Show, where we talk all things money, real estate, and entrepreneurship. And in today's episode, we are going to talk about what is the best way to refinance a mortgage. So if you haven't heard, we are at all-time lows for interest rates, meaning that borrowing money has never been cheaper in the history of the United States. And I'm not an expert on other countries, but I'd guess it's very similar in those countries as well. So when there are cheap interest rates, that typically means a lot of people want to buy housing and a lot of people want to refinance their current housing. So you're going to start to see investors refinance their portfolios. You're going to start to see owner-occupants refinance their primaries. And it makes sense to do. If you can go knock your interest rate down, why not? All the people that have bought properties in the last 5 years and maybe they have an interest rate that's 4 to 6% can now go refinance and get a 2 to 3% interest rate. The savings on your monthly payment would be massive. So the big thing that people don't know is what kind of refinance should they do? There are a lot of different options out there, but they don't know exactly what they mean. So I'm gonna break down the top 3 ways that you can refinance and help you understand the pros and cons of each so that you can make the best decision for your refinance. So let's jump into it. The number one most common type of refinance is the rate and term. And if you're wondering what a rate and term is, it's very simple. You are just refinancing the current balance of your loan. You're not taking any money out, you're not increasing it, you're not decreasing it, it's gonna stay the same. So if you owe $200,000 on your home, you're refinancing that full $200,000. So you might be saying, why would you do this? So let's take a $200,000 loan, for example. Now we're only gonna talk about principal and interest. Property taxes and insurance are different in every place, but principal and interest are the same no matter where you're at. So on a $200,000 loan at 5% interest, the principal and interest payment will be $1,073. Now let's take that same $200,000 loan and do it at 3% interest. Your payment drops from $1,073 to $843. So you save over $200 and almost 20% of your payment. So if you're gonna do a rate and term, all you're really checking to see is what's the difference between my current payment versus what it could be if I refinance. Now it's not as simple as just saying, yeah, I'll do that. Cheaper payment, that's cool. There are some other considerations, such as you're starting a new amortization. So for those of you who don't know, when you start a 30-year loan, the majority of the loan up front is all interest. As the loan matures, you start paying more principal as you go on. And towards the very end of the loan, it's almost all principal and no interest. So what exactly does that mean? Well, if you're into a loan 15 years already, it might be more beneficial for you to just keep that loan versus refinance it. Yes, you might get a cheaper payment, but you're paying down more principal with your mature loan. So cheaper payment doesn't always equal better, especially if you're deep into your loan. I should also mention too, the figures I gave you before are based on getting a 30-year loan, which is what most people do. On top of that, every time you refinance, you're gonna have to pay closing cost again. So you gotta pay your lender a fee, you also have to pay the title company fees, so there are going to be other costs. So you need to do an analysis. If it's gonna cost you, say, $3,000 in fees, and you're gonna save $200 every month, that means you'll break even after about 15 months. So if you plan to keep your house for the long haul, after 15 months, then yes, you're gonna start actually reaping the rewards of the refinance. So it's really gonna depend on your situation. How quick do you wanna sell? What's your current interest rate? How deep are you into your current loan? Those are all gonna play a factor on if refinancing is right for you. So that's the rate and term refi, it's very common. Let's get into the second type, and that is the cash out refinance. So a cash out refi is pretty much how it sounds. You are going to refinance, but you're actually gonna get cash back. So let's take the original example. You have a loan for $200,000. And let's say that your house is worth $400,000. So you have a $200,000 loan, and then you have another $200,000 in equity. Now, the way a cash out refi works is they are going to take its appraised value and give you a percentage of that. And the percentage will vary. It depends if you have a primary residence or a rental property. But typically on a rental property, they'll give you 75 to 80% of appraised value. So let's take the first example and say you have a $200,000 loan, but the property is now worth $400,000. So they're gonna take the $400,000 and give you 75% of that. 75% of 400,000 is $300,000. So you have this difference between your current loan, which is $200,000, and the loan they're willing to give you, which is $300,000. So now that you have this $100,000 difference, when you refinance, they are now gonna give you $100,000 cash, which is completely tax-free and awesome. But the downside is your loan is now $300,000. So even if you got a lower interest rate, more than likely your payment has gone up, and also your amortization has started over again. You're back at year 1 of 30, paying mainly interest. But on the bright side, you have $100,000 cash that is tax-free, and now you can go invest that in other ventures. I love the cash out refi. That's typically what we do with our rentals. Another thing to consider is that with the cash out refi, it's typically gonna have a higher interest rate than a rate and term refi. Also, rental properties typically have a higher interest rate than primary residence. So that's how a cash out refi works. The last type of refinance is a home equity line of credit. And some people wouldn't even consider this a refinance, but I'm gonna throw it in there because it's very common. And they're called HELOCs for short, and they can actually combine the best of both worlds. Let me explain. So what a HELOC is going to do is put a second position lien on top of your current mortgage. So in the example we've been going with, you have a loan for $200,000 currently. Instead of refinancing that full loan, you're actually gonna just keep it in place. And then you're gonna add a second loan, which is called a HELOC, and it's a loan that you can actually tap into whenever you want. You don't have to use it. So you're gonna use it as a line of credit against the property when you need it. So in the example we've been using, let's say you have that property, it's worth $400,000. You have the $200,000 original loan, and now they're willing to give you a home equity line of credit for $100,000. The beauty is you get to keep that existing loan. So if it's deep in the amortization, it's better to keep that in place. And then on top of that, you can now tap into this line of credit when you need it. So you're only gonna pay interest on it while you're using it. Whereas with the cash out refi, you're gonna refinance everything, get the cash, and you're paying interest on it whether you use the cash or not. So a lot of people prefer HELOCs over cash out refinances just because of the flexibility they give. And the percentage that companies are willing to give on a HELOC vary. In the example I'm using, they'd be giving up to 75% because they're capping it at $300,000 when the property is worth $400,000. But I actually have a HELOC in my personal residence, and they give up to 95% of value, which is awesome for me because I know I can go use that HELOC money and flip houses. So there's definitely a big difference between personal and a rental property. So you might be saying, well,
What's the downside to a HELOC?
the one downside is that the interest rate is typically higher than other loans. I wanna say on my personal residence, my HELOC is at about 7%. I have not tried to refinance it. I'm sure that there are cheaper options right now, but that's what I currently pay. So in the end, it really just depends on your situation. Is it a primary residence? Is it a rental property? How long have you had your loan for? Do you wanna pull the cash out and get a really cheap rate? How long do you plan to live in the house? These are all considerations that you need to take when you're refinancing. Don't just get caught in the trap of, hey, it's a low interest rate, I'm gonna make money. That's not always the case. You might actually cost yourself money by doing it. Anyways, guys, if you got value out of this, do me a big favor, go hit that like button. If you haven't already, go hit the subscribe button. And if you want to get notified every time I release a new video, go hit the bell notification. Go follow me on all the socials. That's a lot of calls to action, right? And after you do all of that, watch another video on this channel. And as always, take care. Hey guys, I hope you enjoyed that video. If you did and you want to watch more videos just like that, I want to encourage you to go check out my channel. We've got a lot of cool things that you guys can use. We've got different playlists for different categories. You can go check out our real estate playlist where we go over flipping, wholesaling, Airbnbs, you name it. You can check out our finance playlist where we go over budgeting, credit, what's going on in the economy. And if you want to see my favorite playlist, go check out our weekly vlog. That's where I personally film the behind the scenes of what's going on in my life, different deals we're making, different things we're doing. I love the vlogs, and I think you guys will too. So if you liked that last video you saw, go check out the rest of these. And if you haven't already, make sure you go subscribe to the channel so you guys get notified every time we release a new one. And I appreciate you for visiting. Take care.